Here's a question that nobody in finance asks out loud. What if the best investments of the last decade were ones you were never allowed to make? Not because you weren't smart enough, not because you lacked the right instincts, simply because you didn't have the right connections. That's not hypothetical. That's been the reality of private markets until now. Private markets, venture capital, pre IPO rounds, growth equity have always been the exclusive domain of institutional investors. Pension funds, sovereign wealth funds, family offices with hundreds of millions to deploy. The entry ticket, usually $1 million minimum, and you had to prove you were already wealthy just to get through the door. The result is that the most explosive growth phases of the biggest companies of our era, Stripe, SpaceX, Databricks, played out entirely in private. By the time regular investors could participate, the compounding was already done. And here's the scale of what we're talking about. In the year 2000, there were roughly 7,000 publicly listed companies in the US. Today, 4,000. The public markets have actually shrunk. Meanwhile, the private market has ballooned to an estimated $10 trillion in value. More than 6.5 times as many significant companies are now private as public. That's not a niche asset class. That's where the economy is actually happening, and most investors have no access to it. In 2016, there were 114 unicorn companies in the US. That's private companies worth over $1 billion, already a significant number. But by 2025, that figure had reached 857, almost 8 times as many. Every single one of those companies built that value entirely in private markets, in funding rounds that most investors could never access. Think about that. $857 billion plus companies, none of which you can find on the NYSE or NASDAQ. The unicorn era wasn't just a Silicon Valley story. It was the largest private wealth creation event in history, and most people watched from the outside. And companies are deliberately staying private for longer. Back in the 1980s and 90s, the median company went public after about 6 to 8 years. Today, 14 years. Think about what that means in practice. 14 years of compounding revenue growth, market expansion, and valuation appreciation, all happening before a single retail investor can buy a share. When the Fed started raising rates in 2022, the IPO window effectively closed. Private capital was still available, companies had no reason to go public, and so they didn't. The most exciting phase of a company's life, the phase where valuations can multiply 10, 20, 50 times, plays out entirely in private. Now layer in the AI story. Since last April, analysts have revised up 2026 earnings estimates for the Magnificent Seven, the big tech giants, by around 11%. The other 493 companies in the S&P 500, pretty much flat. The market is delivering a very clear message. The gains from AI are not expected to be broadly shared. They're expected to be captured by the companies building the AI infrastructure. And the most powerful of those, Databricks, for one, are still entirely private. The public market AI trade is already crowded. The private market AI trade is where the opportunity sits. One last chart, and it's counterintuitive. Since April last year, small cap companies with negative earnings have outperformed those with positive earnings by nearly 20 percentage points. The market is not rewarding profitability right now. It is rewarding growth trajectories, high conviction bets on what a company will become, not what it earned last quarter. That is the exact profile of private market companies, growing fast, investing aggressively, often pre-profit. And that tells you the investment environment is actually favorable for precisely what RVI holds. So, what if you could actually get in, not through some opaque fund that requires $1 million commitment and proof of wealth, but through a brokerage account you already have at $25 per share with no accreditation requirement and the ability to buy or sell any day the market is open? That is Robinhood Ventures Fund I, ticker RVI. It's a publicly traded closed-end fund, the first of its kind, that holds stakes in some of the most valuable private companies on the planet. Robinhood CEO Vlad Tenev described it as resolving one of the greatest long-standing inequities in capital markets today. Let's look at what's actually inside. The initial portfolio includes 7 companies: Airwallex, Boom, Databricks, Mercor, Aura, Ramp, and Revolut, spanning AI infrastructure, digital banking, fintech payments, health technology, and next-generation aviation. Stripe is expected to be added post-IPO once the acquisition agreement closes. Let's go deep on the 3 biggest names, because the individual stories here are genuinely compelling. First, Databricks. If they're not on your radar yet, they will be soon. Databricks is the data platform that enterprises actually use to build and run AI at scale, the operating layer underneath the AI revolution. Think of them as the infrastructure every serious company needs before they can do anything real with artificial intelligence. In January 2026, Databricks reported annualized revenue surpassing $5.4 billion, growing at 65% year over year. 1.4 billion of that is coming purely from AI products. Their funding round completed in February 2026 at a $134 billion valuation. That is bigger than dozens of S&P 500 companies, and they have never traded on a public exchange. Through RVI, they can. Second, Stripe, the invisible infrastructure that powers a staggering share of internet commerce. Over 1.5 million businesses run their payments through Stripe. From seed stage startups to Fortune 500 companies, in 2024, they processed more than $1 trillion in total payment volume, with revenues hitting $5.1 billion, up 28%. They're profitable and dominant in their category. Stripe has been the subject of IPO speculation for years. Multiple windows have opened and closed. Valuations have been cited anywhere between $90 and $107 billion, depending on the round. Robinhood has already entered an agreement to purchase Stripe shares for the fund post-IPO. For investors thinking about the eventual public listing, getting in through RVI at today's private market pricing is the setup. Third, Revolut. If you're in Europe or Asia, you may already be a customer. If you're in the US, you're about to hear a lot more about this company. What started as a travel money card is now a full-spectrum digital bank with 50 million customers across 38 countries, offering everything from currency exchange to stock trading to crypto to insurance. In 2024, revenue reached $4 billion, up 72%, with profit before tax more than doubling to $1.4 billion. A secondary share sale in November 2025 valued the company at $75 billion, up from $45 billion just 15 months earlier. Management is publicly targeting $9 billion in revenue and $3.5 billion in profit for 2026. A US IPO that could push the valuation past $100 billion is on the horizon. The trajectory is remarkable. Now here's the honest conversation, the one you deserve to have before you invest a single dollar. Databricks is valued at $134 billion, Stripe near $100 billion, Revolut at $75 billion. These are not undiscovered startups. The venture funds, the sovereign wealth funds, the institutional money, they got in years ago at single-digit billions in some cases. By the time RVI lists at $25 a share, a lot of that orange has already been squeezed. That doesn't mean there's no juice left. If Databricks grows into a $200 billion IPO, which is plausible given the AI tailwind, RVI investors still make real money. If Revolut hits its $9 billion revenue target and lists at $120 billion valuation, same story. But you need to go in clear-eyed. This is not a seed round. You're not buying Databricks at a $10 million valuation. You're buying in late with access that didn't exist before, but late nonetheless. Understanding that distinction is the difference between investing and gambling. Here's something that most commentary on RVI glosses over, and it's actually one of the most interesting dynamics in the whole structure. RVI is a closed-end fund. That means unlike an ETF, where the price tracks the underlying assets directly, the RVI share price on the NYSE is set by the market, by buyers and sellers, by greed and fear. The fund's NAV, the actual calculated value of Databricks plus Stripe plus Revolut and the rest, updates quarterly, but the stock trades every second the market is open. What that means in practice? In a bull market, when investors are risk-on, when AI is the hottest trade in the room, and when everyone wants private market exposure, RVI shares could trade at a significant premium to NAV, 20%, 30%, 40%. Tech closed-end funds during the dot-com boom traded at premiums in that range. In that scenario, the RVI stock price runs harder than the actual companies inside it. That's a potential amplifier. And it's a genuine upside that goes beyond just the portfolio performance. But it cuts the other way too. In a risk-off environment, a recession scare, a rate spike, a market rotation away from growth, RVI shares could drop to a steep discount to NAV. The stock falls even if Databricks just posted 65% revenue growth, because in that moment, people aren't buying the companies, they're selling the sentiment. The bottom line, Your return on RVI is a function of two separate bets, one on the underlying companies and one on whether markets stay risk on. Know which one you're actually making. Now, a few things worth knowing about how RVI actually works. No investment minimum beyond the share price, no accreditation requirement. This isn't gated to wealthy investors. Daily liquidity. You can buy or sell on the NYSE any trading day. No performance fee, which is nearly unheard of in private market investing. The management fee is 2% annually, reduced to 1% for the first 6 months post IPO. To be clear, this is a speculative concentrated fund. Private company valuations carry real uncertainty, and RVI shares can trade at a discount or premium to the fund's net asset value. Read the prospectus, but as a structure for accessing private markets, what Robinhood has built here is genuinely new. 857 unicorns, 14 years before going public. High earnings concentrated in a handful of private companies. The data has been telling the same story for years. The wealth is being created in private markets, and retail investors have been on the outside. For the first time, there's a key. Robinhood Ventures Fund I, ticker RVI, IPOing in the coming weeks on the New York Stock Exchange. The question isn't whether private markets matter, it's whether you're going to be on the inside this time. That's RVI, a $25 entry point into some of the most valuable private companies on the planet, with all the nuance, the risks, and the mechanics that most videos won't tell you about. If you found this useful, hit the like button. It genuinely helps more people find this kind of content. And if you want to follow along as RV, I actually starts trading as these companies move toward IPO, and as the macro picture keeps shifting, subscribe and turn on notifications. This channel covers the stuff that matters: macro trends, private markets, and the companies shaping what comes next. I'll see you in the next one.